Can you believe it? We're in the last month of 2022 already. That means the year is ending and you only have a month to grab some tax savings for 2022 before it's gone forever. So, watch today's video and use it as a checklist to take actions. That way, you are not leaving money on the table and you can get a head start with your 2022 tax return, which will be due on Monday, April 18th, 2023. Hi, I'm Prudence Zhu, CPA and financial planner. I provide tax and wealth strategies to professionals and small business owners so that they can take control of their money and enjoy financial security and freedom. First on the list is one technique many wealthy people use, and you must do it before the calendar year ends. It's called tax loss harvesting, which means you can sell securities at a loss to offset the amount of capital gains tax due on the sale of other securities at a profit. Suppose your capital loss exceeds your current year's capital gain, you can also offset up to $3,000 of ordinary income as a family each year. Then if you still have amounts left over, you can roll it to the following years and still benefit from it. This strategy would work well for things you are not planning to hold in the long run or what turned out to be bad investments. However, 2022 was a challenging year for many investment categories, so it might be worthwhile to scan your portfolio and decide if it's time to get rid of some of them and harvest the loss. For example, if you made $5,000 in stock trading or taxable distribution this year and another stock's losing $9,000, you can sell it and use it to offset your $5,000 gain. And you can then use $3,000 to offset your earned income, such as salary or side income. And the last $1,000 loss would be carried over to offset your capital gain or income next year. If you're in the 22% tax bracket, that's worth up to $1,760 in taxes this year and $220 next year. You have to be careful to avoid wash sales in execution. That is to say, the sales cannot be within 30 days before or after another purchase of the same or substantially the same security. Otherwise, the price difference would lower the tax basis of the stock you own instead of creating an actual loss. Interestingly, the wash sale rule only applies to securities or stocks, and cryptocurrency is considered property by the IRS and thus not a security. So, the silver lining is that cryptocurrency doesn't fall under the existing wash sale rules. The second on the list is the Roth Conversion, which must be done also by December 31st. It means converting money from your pre-tax retirement accounts, such as 401k and 403b, to traditional IRA and then to Roth IRA. A conversion is a taxable event, so you'll have to pay income tax on the amount you convert. However, the benefit is that you won't have to pay capital gain or distribution tax when you take the money out at retirement. It is most beneficial if you are in a low tax bracket this year due to unemployment or starting a new business, for example. People also like to do it in a bear market to benefit from tax-free growth when the market rebounds. The third reason why people talk about Roth conversion is the expected higher tax rate when the Tax Cuts and Jobs Act expires in 2026. But we still have a few years left. However, we may or may not see another bear market before then. By the way, the 2022 contribution to Roth and traditional IRA deadline is April 18th, 2023. And it would be best if you remember to tell your plan to your tax preparer so that you can fully benefit from any applicable tax savings. The third on the list is to max out your tax-advantaged accounts due by the end of the year, such as 401k, 403b, 457, thrift savings plan, and solo 401k employee portion. The contribution limit for 2022 is $20,500 per employee, and if you are 50 or older, you can contribute an additional $6,500 as a catch-up. You might have to act quickly since most plans lag on when they can execute the change. And it might be a good idea to ask your plan provider about when you could make changes to impact 2022 contributions. Again, the contribution amounts will lower your current year's tax liability if they are pre-tax contributions. And I explained how it works in this video. Check it out if you want to learn more. Let's take Mr. and Mrs. Aspire as an example to highlight the impact of using tax-advantaged accounts. If you are new to my channel, they are a double-income household making $135,000 a year. If they didn't contribute anything to their 401k or HSA and take a standard deduction, their taxable income would be $109,100. They would be in the 22% tax bracket, and their taxable income would be $15,236. However, if they max out their 401k and HSA contribution, their taxable income would be decreased by $48,300, which is the total of their contributions, namely $41,000 for two 401ks and $7,300 for family HSA. As a result, their taxable income would be $60,800. Their federal tax liability in 2022 would be $6,885. By maxing out their tax-advantaged accounts, they could save $8,351 in taxes in 2022. Number 4, max out other tax-advantaged accounts, such as Health Savings Account, 529, and Coverdell Education Savings Account. The 529 contribution is due at year-end, and HSA and Coverdell ESA are due on the tax filing date. In 2022, the HSA contribution limit is $3,650 for self-only and $7,300 for families, with a $1,000 catch-up amount for individuals age 55 or older. And if you make an HSA contribution directly with your after-tax money, make sure to fill out your tax return correctly on your 1040 form so you can deduct the equivalent amount from your taxable income. Finally, if all of those different tax-advantaged accounts make you dizzy, I also made a video to put them under an easy-to-understand structure, and you can watch it here. Number 5, if you put aside money for a flexible spending account, reimburse yourself timely and before the balance is reset. A flexible spending account differs from a savings account because the balance doesn't grow over time and you have to use it within the planned year or within the grace period, which is usually 2.5 months. It would help if you asked your employer about your company's specific rules. The most common types of FSA are healthcare, dependent care, and transit. So you need to use the money on the account or submit your reimbursement claim for the prior year's expense at the beginning of the following year at the latest. For example, our family doesn't have a healthcare FSA since we have an HSA, but we contribute to dependent care FSA for kids' childcare expenses. So I usually ask for the statement in January to minimize administrative burden and file FSA reimbursement soon after. And I would get a $5,000 check by the end of January. And as for the healthcare flexible spending account, an easy way to use it up is to purchase FSA eligible items on Amazon. They range from over-the-counter medicine and first aid to electronic toothbrushes, massage guns, and heating pads. And if you buy it now, it could even be a good Christmas gift. Number 6, time your donations and gifts wisely. If you donate significant amounts, you can only take the deduction or benefit from the tax savings if you itemize your deduction. So, if you expect to take the standard deduction in 2022, consider grouping your charitable contributions or contributing to a donor-advised fund every few years. That way you can choose which years to donate and itemize your deductions. Also, are you planning to make any gifts this year? You don't have to pay any gift tax on up to an annual exclusion amount of $16,000 per year per donee. Number 7, if you received any significant amount of money in 2022, this might include inheritance, vesting of restricted stock units, stock options, big bonus, property sale, etc. Consider hiring a CPA to estimate your current year's tax liability so that you know what's coming. And second, you would also have time to deduct or defer. And the third benefit would be you would know if you need to make an estimated tax payment by January 17th, 2023 to avoid underpayment penalties. Generally, most taxpayers can avoid a penalty if they own less than $1,000 in taxes after subtracting their withholdings or credits, or if they paid at least 90% of the tax for the current year or 100% of the tax showing on the return for the prior year, whichever is smaller. Lastly, if you are a business owner, consider the timing of your revenue and expenses. For example, if your net income is high in 2022, consider deferring some revenue to early 2023. And if your accounting term is cash-based, consider prepaying some expenses, such as annual subscriptions and software. And if you sell physical products, buying more inventory by the end of the year can also lower your taxable income this year. And if you still need to offset more net income, consider increasing employer profit sharing contribution to your solo 401k up to 25% of your compensation, or up to $61,000 in 2022. Finally, suppose you have a pass-through entity such as a sole proprietor, S corporation, or S partnership with certain income levels. You might qualify for a qualified business income deduction (QBI), providing further tax savings. Effectively, business owners can deduct and defer more taxes than average W-2 workers. I hope today's episode inspired you to take the opportunity and pocket some tax savings for 2022. If you liked it, please give it a thumbs up and share it with others. We're also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!